Are you getting your financial advice from someone who drives a Lamborghini on TikTok? Or maybe just someone who looks like they do? Welcome to the Money Debate. Our mission today is to take a really deep dive into the world of financial influencers, the finfluencers, as they're called. We're going to unpack whether they're genuinely modern gurus guiding us all to wealth, or if they're potentially dangerous amateurs leading us down a pretty risky path. So let's start with the appeal. I mean, we've all seen them, right? These social media personalities promoting financial products, sharing tips. Why are they so captivating? Why do people listen?
Yeah, it's a great question. I think what's really fascinating here is their perceived accessibility. It feels easy.
Right.
For so many people, traditional financial advice seems, I don't know, daunting. Maybe
Yeah.
expensive, full of jargon they don't understand.
Totally. It feels like a closed club sometimes.
Exactly. But then you go on social media and it seems easy to access, simple to understand, and hey, it's often free. They're really reshaping how millions perceive risk and investment opportunities. They're especially appealing, I think, to younger audiences or those just looking for quick wins or, some casual finance tips.
You mentioned quick wins. That seems key. It feels like that promise of easy money, the fancy cars, the vacations, that often gets highlighted, doesn't it?
Yeah.
Even if maybe it's not always the full picture.
Oh, absolutely. That visual hook is powerful.
It really draws people in, especially, I imagine, new investors, maybe people using those self-service mobile trading apps. They see the lifestyle and think, okay, that's the goal.
Yeah, I want that. And this person seems to have the secret. But unfortunately, this appeal, this kind of magnetic quality, it can mask some pretty significant dangers. The sources we looked at reveal a bit of a dark side here. Financial misinformation can pop up as, well, outright false claims sometimes. Or maybe misleading content, market manipulation schemes, pump and dumps, that kind of thing. And even straightforward fraudulent investment opportunities.
So it's not just like slightly off advice. It can be actively deceptive.
Precisely. And we've seen the damage financial misinformation can do historically, right? Think about Enron with its manipulated financial reports.
Right, a classic example.
Or Theranos, built entirely on false technological claims. Those are huge scandals. But today, the digital age, especially with the rise of cryptocurrencies, has just opened up so many new avenues for these scams.
Easier to reach people, I guess.
It's much easier. Scams promising incredibly high returns with little or apparently no risk. They might use fake testimonials or even misuse celebrity endorsements, deep fakes or just unauthorized associations. There's even, get this, a song called Wire Fraud Tutorial that literally details how to commit financial fraud. It got millions of views.
Wow, that's chilling. It sort of normalizes it in a weird way.
It really does. It speaks to a strange cultural moment.
Okay, so beyond the outright scams and fraud, how do these finfluencers, and maybe the platforms themselves, exploit our sort of natural human tendencies, our psychology?
Ah, that's a crucial point. Because they absolutely do tap into our behavioral biases. We all have them.
Like what? Give me an example.
Okay, well, a big one is loss aversion. We feel the pain of losing, say, $100 much more intensely than the pleasure of gaining $100.
Uh-huh. That makes sense.
Finfluencers can play on that. They create urgency, don't miss out, or protect your gains now, pushing you towards impulsive decisions maybe based on fear.
Got it. Fear of missing out, FOMO, or fear of losing what you have.
Exactly. Then there's the framing effect. How you present information dramatically changes how we react to it. Simply rephrasing a risky investment as a unique high-growth opportunity can make it sound much more appealing, even if the underlying risk is exactly the same.
Okay. Yeah, I can see that. Marketing spin, basically.
It's much. And another one, the endowment effect. We tend to overvalue things we already own.
Like my old concert t-shirts.
Sort of. But with investments, it means we might be reluctant to sell a stock that's doing poorly just because we own it, even if rationally we should cut our losses. We feel attached.
Okay. That keeps us stuck.
It can, and we also see recency bias everywhere. People tend to overemphasize recent events.
How does that play out with finfluencers?
Well, they'll showcase recent wins, maybe a tech stock that soared. Followers then pile in, influenced by that recent performance. Maybe just before the market corrects, they buy high.
Ouch. Based on past performance, not future potential.
Right. And finally, there's confirmation bias. We all tend to seek out information that confirms what we already believe or want to believe.
Uh-huh. We filter out the uncomfortable stuff.
Exactly. Finfluencers can feed into that by providing content that validates your hopes maybe for a particular stock or crypto, while you, the listener, might subconsciously ignore the red flags or the counterarguments.
It's fascinating and a bit scary how these platforms seem almost designed to amplify these biases.
Well, that leads us right into gamification.
Gamification, making it like a game.
Precisely. Applying game decision elements, things like points, levels, leaderboards, flashy graphics, even surprise stock awards, to a non-gaming context like investing.
Okay, I've seen that. Streaks for logging in, confetti when you make a trade.
Yes, digital trading platforms use all these tricks. It makes investing feel less like serious financial planning and more like, well, like you said, a game. You get little dopamine hits for participating.
Here's where it gets really interesting for me. How do these game-like features actually impact real investing behavior? Is it just a bit of fun, or does it genuinely change how people manage their money?
Oh, it definitely has an impact. The research shows these tactics can significantly increase how often people trade.
Really? Like how much?
One experiment found that participants who were put in a group that got points for activity made 39% more trades than a control group.
39%. Wow, that's substantial.
It is. And more broadly, these features don't just increase frequency, they can nudge people towards trading riskier products, things like options or meme stocks. They might change their investment strategy inappropriately, moving away from long-term goals towards short-term speculation.
So the game encourages riskier plays.
It can. Think about those variable rewards, like the surprise free stock you get for signing up or referring a friend.
Yeah.
Psychologically, those exploit our tendency to get overly excited about large potential rewards, even if the probability of getting them is tiny. It's a known gambling mechanism.
Like a lottery ticket feeling.
Exactly, and the language used matters too. Calling an investment a jackpot or talking about playing the market can put users in what psychologists call a hot state. More emotional, less rational, less sensitive to the actual odds.
And the leaderboards. You mentioned those.
Right. If a leaderboard measures trading activity, it directly incentivizes more trading just to climb the ranks. It taps into competitiveness.
I can see myself falling for that one.
Many people do. Even simple push notifications, those little alerts from the app, they're attention triggers. Studies have linked them to higher risk-taking, especially among younger and less experienced investors who might feel pressure to act immediately.
This sounds so much like what we saw with the whole meme stock thing. GameStop, AMC.
Absolutely. That was a perfect storm, really. You had social media forums, particularly Reddit's Our Wall Street Bets, driving stock prices sky high.
Not based on the company's actual performance.
Wait, not primarily, no. It was driven by collective hype, online momentum, a sort of us versus them mentality against hedge funds. It was pure social contagion.
And then chaos erupted when brokerages like Robinhood Trading 212 Webull actually halted buying on those stocks.
Huge outrage. Retail traders felt cheated. It led to congressional hearings, investigations. It was a major event.
Did anyone actually make money besides the early Redditors?
It was mixed. Many hedge funds did suffer massive losses from short squeezes, but others, like big players, BlackRock for instance, actually profited from the intense volatility. And research confirmed afterwards that for stocks like GameStop and AMC, the technical indicators, the price and volume, went wild. But the fundamental indicators, the company's actual health and value, they barely budged.
So it was mostly just noise and emotion.
A huge amount of it, yes. It really highlighted the power of social contagion, especially how negative emotions, anger, resentment, can spread like wildfire through social networks and drive collective, often irrational behavior, a herd mentality, essentially.
So, okay, bringing you back to you, our listener, you might be watching these finfluencers, seeing the meme stock stories, maybe getting drawn to the idea of making easy money with quick trades. What's the cold, hard reality check here?
Yeah, the reality of active trading, especially day trading, which is often implicitly or explicitly promoted by some finfluencers, is pretty sobering.
How sobering?
Very. Multiple studies paint a stark picture. Research on day traders consistently shows that the vast majority lose money over time.
The majority.
The vast majority. In one study looking at U.S. day traders, only about half were even profitable before considering commissions and fees, after costs. Far fewer.
Wow.
Another large study, this one on thousands of Taiwanese day traders, found only about 20% managed to earn positive returns beyond what you'd expect after accounting for fees. 20%.
So 4 out of 5 lost money or broke even, essentially.
Pretty much. And often the few who are consistently profitable are succeeding partly at the expense of the less skilled traders in the market. It's often close to a zero-sum game, especially in the very short term.
That definitely bursts the get-rich-quick bubble.
It really should. The odds are heavily stacked against short-term active traders.
Which, okay, raises a really important question then. What are regulators doing about all this? The finfluencers, the gamification, the potential for misinformation, and maybe more importantly, how can you protect yourself?
That's the critical next step, isn't it? Regulators globally are paying attention. Agencies like the Financial Conduct Authority, the FCA in the UK, or the Ontario Securities Commission, the OSC here in Canada, are definitely increasing their scrutiny.
What are they actually doing?
Well, the FCA, for example, has conducted international crackdowns. They've made arrests, initiated criminal proceedings against unauthorized promoters, and issued hundreds of takedown requests to social media platforms for content from unauthorized finfluencers.
They're going after the individuals.
Yes, and sending a clear message. If you promote financial products, you generally need to be authorized to do so. Otherwise, you could face serious consequences.
Okay, that's enforcement. What about prevention? Stopping people from being misled in the first place.
They're exploring various strategies there too, obvious things like clear disclosures, warnings about risk, but also more innovative approaches, things like pre-bunking.
Pre-bunking, like debunking.
Right, exactly. It's like a mental vaccine. You expose people to the tactics of misinformation proactively, showing them how misleading arguments are constructed, so when they encounter the real thing later, they're already inoculated against it.
Huh. Interesting idea.
Yeah, and related to that is inoculation theory itself, presenting people with a weak version of a persuasive message and then immediately refuting it, which strengthens the resistance to stronger versions later.
Building up immunity to bad arguments.
Kind of, yes.
Yeah.
And then there are nudges, simpler interventions like displaying a warning message right before someone clicks to purchase a high-risk asset, just making them pause and think twice.
Do these things work?
They can help. Studies show they can reduce the influence of misinformation and risky behavior, but they don't fully eliminate it. It's complex. And it's worth remembering, traditional news media, for all its flaws, generally still operates under more established journalistic standards and fact-checking processes compared to the wild west of social media. Social media lacks that standardization, and its algorithms can actually amplify sensational or false information because it gets more engagement.
Right. The algorithm isn't designed for truth. It's designed for clicks and watch time.
Precisely. So regulators face a real uphill battle trying to police that kind of environment.
So if the finfluencer world, with its quick cash promises and game-like apps, can be so misleading, what does genuine successful investing actually look like for you, the listener, trying to navigate this crazy digital age?
You know, it's almost the polar opposite of what many finfluencers seem to promote.
How so?
Successful long-term investing isn't about excitement and quick flips. It's often, well, honestly, it's often kind of boring. And that boredom is actually a feature, not a bug.
Boring is good.
In this context, yes. It's your shield against the constant stimulation and the false urgency that finfluencers and gamified platforms thrive on. True financial wisdom today might actually look like actively choosing the path of less engagement with the daily noise. Successful investors focus on long-term thinking, decades, not days or weeks. They're not trying to get rich quickly, they're trying to build wealth steadily.
And how do they view market volatility, the crashes?
They tend to see market drops not as reasons to panic sell, but as potential opportunities to buy quality investments at a discount. They focus on the underlying value of a company or an asset, its fundamentals, rather than chasing fleeting trends or following the crowd's latest obsession on social media.
So controlling emotions is key.
Absolutely crucial. Staying calm and rational whether the market is soaring or plummeting. Avoiding those risky, impulsive moves driven by fear or greed. Thinking things through. Real, sustainable wealth building typically comes from having a long time horizon, staying invested through ups and downs, having a properly diversified portfolio that matches your risk tolerance, and most importantly, discipline. Sticking to your plan.
Discipline seems like the hardest part when everything online is yelling axe now.
It is. Consider a historical example. like the Rockefeller family's wealth management over generations. They navigated over 85 years of incredible market volatility wars, pandemics, recessions, booms, busts. Their long-term success reportedly stemmed significantly from avoiding the temptation to make emotional, short-term decisions based on the crisis of the day. They had discipline and a long view.
That's a powerful contrast to the finfluencer hype. It really underscored the need for critical thinking, for seeking out solid financial education, not just bite-sized entertainment disguised as advice.
Exactly. Know the difference between education and entertainment.
So, in this world where financial advice is delivered in 60-second videos between dance challenges, what does true financial wisdom even look like for you? Especially when so much of the noise actively encourages you to be less wise, more impulsive. Something to think about. Thank you for joining us on this deep dive here on The Money Debate. If you found this discussion valuable, please do subscribe to our channel for more insights like this. And just a reminder, a really important one, the information shared here today is strictly for entertainment and informational purposes only. It is absolutely not financial advice. You should always consult with a qualified independent financial advisor before making any investment decisions.